Well, good afternoon, ladies and gentlemen. I'm Dan Murphy from CNBC, and I'm absolutely thrilled to be with you this afternoon. Welcome to OPEC headquarters here in Vienna. To all of you here joining us today, and of course, all of you also joining us on this live stream online. Thank you for joining us for the launch of the World Oil Outlook. This has become one of this industry's most closely watched publications. It provides analysis and long-term perspectives on energy demand, on supply, on investment, and of course, the broader evolution of the global energy landscape. We have an excellent program ahead for you, beginning now with the opening remarks from the Secretary General of OPEC himself. Ladies and gentlemen, please join me in welcoming His Excellency Haitham Al-Ghais, the Secretary General of OPEC. Sir, the floor is yours.
Thank you, Dan. Ladies and gentlemen, dear friends, good afternoon, and thank you to everyone joining us in person here in Vienna and via live stream for the launch of the World Oil Outlook, the WOO 2026 edition. The launch of OPEC's flagship annual publication is always a special day on our calendar of events, but it is particularly significant this year as we celebrate the 20th edition of the Outlook. Over 2 decades, the Outlook has become a key part of OPEC's voice on evolving energy futures. It offers data-driven, transparent, and objective views that aid policymakers worldwide. Acknowledging long-term energy trends is essential, as energy systems require decades of planning, investment, and coordination. Published since 2007, it's interesting to note that the reference case in our very first Outlook anticipated that global oil demand in 2025, last year, would reach around 110 million barrels per day. While actual demand that year was slightly over 105 million barrels a day, up by over 27 million barrels a day from 2005 levels, the central message of our first Outlook proved to be entirely correct. Global oil demand grew very strongly, even through a period shaped by a global financial crisis as well as the pandemic. Just as our team in 2007 expected strong oil demand growth out to 2025, our team in 2026 expects further robust growth out to 2050. In this regard, it's perhaps fitting that a central message of this year's Outlook is that prudent energy policymaking necessitates remaining focused on the key long-term trends and the underlying drivers shaping our energy futures. Day-to-day developments are important, yes, but recent history reminds us not to underestimate the resilience of these underlying drivers. During the COVID-19 pandemic, many feared lasting disruption to both the global economy and oil markets. Instead, both recovered strongly, demonstrating the resilience of our economies, the strength of our industry, and the growing demand for its products. This lesson is particularly relevant today amid what has been a volatile year for global energy markets. Now, against this backdrop, this year's Outlook provides a comprehensive medium and long-term snapshot of the global energy landscape through to 2050. In doing so, our team has worked very hard to capture the opportunities whilst being fully aware of the challenges and the uncertainties related to our energy futures. The result is an Outlook spanning almost 300 pages of data and analysis, covering topics ranging from energy demand, supply, and downstream to energy scenarios, and a dedicated section on Africa. While my colleagues will provide further details in due course, I would like to briefly mention 5 high-level key takeaways from the 20th Outlook. First, many governments around the world continue to reevaluate their energy policies. This reflects policymakers' efforts to strike a balance between delivering energy security, ensuring energy availability, reducing emissions, and fostering sustainable development. Globally, there is a renewed appreciation that hydrocarbons like oil and its associated petroleum products remain vital for both the global economy and daily life. Second, global primary energy demand will continue to expand. From now until 2050, the outlook our outlook sees it increasing by 23%, with this growth coming almost entirely from developing countries around the world. Of note, by 2050, we expect oil to retain the largest share in the energy mix at around 30%. We also see global demand reaching just above 124 million barrels a day by 2050. And let me say it again, there is no peak oil demand on the horizon. Third, the scale of humanity's current and future energy consumption means that this year's outlook retains OPEC's long-held view that all sources of energy will be required to meet the world's energy needs. This is clearly reflected in the outlook's long-term trends. These show growth across every energy source apart from coal. Fourth, the outlook underscores the importance of continued efforts to reduce emissions. This includes through technologies such as carbon capture, utilization, and storage, direct air capture, as well as frameworks such as the circular carbon economy. Many OPEC member countries are making significant investments in these technologies, as well as renewables to support these efforts. Fifth, major investments in all energies and all technologies are vital. For oil alone, investments of $17.7 trillion are required from now to 2050. That is over $700 billion per annum. Those are needed to meet demand in the long run. What these 5 points collectively underline is that the scale of humanity's energy needs requires sustained investments today across all energies and technologies. This is vital to meet growing demand, to enhance energy security, to improve affordability, and of course, to reduce emissions. Delivering on all counts also requires long-term policy certainty. Before closing, ladies and gentlemen, I would like to extend my sincere thanks to everyone involved in bringing this valuable publication to life. The 20th OPEC World Oil Outlook is a result of an extraordinary collective effort in the OPEC Secretariat. It draws on the knowledge, dedication, and the close collaboration from my colleagues in the organization and from our member countries, and those colleagues whose commitment to excellence continues to strengthen our research every year. Today's Outlook is launched with the same objective that guided our very first Outlook back in 2007, to contribute to a better understanding of the evolving global energy landscape and to support informed decision-making, energy security, and market stability in the years and decades ahead. With that, I would like to pass the floor on back to Dan Murphy and to the Director of Research, Dr. Ayed Al-Gahtani, who will then deliver a presentation on the details of the Outlook. Thank you very much for joining us.
Thank you very much, Your Excellency. And His Excellency's words really underscore just how important this year's report is. And as His Excellency just explained, we're going to bring some of these key messages to life now with, of course, a presentation from Dr. Ayed Al-Gahtani, who is the Director of the Research Division at OPEC. Dr. Gahtani, the floor is yours.
Thank you, Dan. Thank you very much, Your Excellency. Good afternoon, Your Excellencies, ladies and gentlemen. It is a great pleasure to present to you the 20th edition of the World Oil Outlook, WOO for short, 2026. The World Oil Outlook is considered by many leaders in the industry to be a key reference publication in the global energy sector, providing valuable insight and detailed outlook and thorough analysis of how the global economy and global energy is most likely to unfold over the next 25 years in the run-up to 2050. The publication is free of charge, and it's downloadable at our website in many forms, not only in PDF, but also in interactive version as well as on the OPEC apps. Now, before I present to you the key findings of the World Oil Outlook 2026, I will dwell very quickly, Your Excellencies, ladies and gentlemen, on the key drivers, the main assumptions that constitutes the backbone of our World Oil Outlook. The significant demographic changes over the forecast period is very important to keep an eye on. We expect the population to increase by almost 1.5 billion people between now and 2050. Similarly, the urbanization, we expect another 1.9 billion people to move to cities by 2050. The economic growth front, we expect the global GDP to double in size at least, and around the demographics, we also have assumptions on energy policies shaped up by the interplay between the energy security, economic development, as well as climate commitments. We also have many assumptions regarding the technology and how most likely it will unfold. Of course, we assume incremental technological development, given the improvement in energy efficiency as well as the reduction in cost of producing things going forward. Indeed, we don't assume any sudden technology breakthrough. On the global energy front, we expect the global primary energy demand to increase by another 23% at least. Of course, oil, as we can see from the charts, will still command its largest share in the global energy mix of almost 30%. The combined energy mix of oil and gas will still constitute north of 50% by 2050. Of course, the renewables, primarily solar, will see the fastest and the largest growth going forward. For the solar, it will see a growth from 7% of the global energy mix in 2050. That's up from the 2% that we've seen last year. Similarly, the renewables energy will see a significant growth going from the 3-4% that we've seen last year to almost 13-14%. The only energy component that we see contracting is the coal. Again, that's on the back of the assumption of tightening environmental policies around the world. In our WU, we give a special focus on electricity generation, supply and demand, generation and consumption. On that regard, we expect the electricity generation to increase from the 32 terawatt hours that we've seen last year to almost 60,000 terawatt hours by 2050. Around 75% of this growth is expected to be in the developing countries led by Asia. And the strongest component that will contribute to that electricity growth will be solar and wind. Again, that's on the back of strong policy support and declining generation costs. Of course, other streams, other fuels will contribute some growth, but definitely we will see coal, as I mentioned earlier, coal-fired generation will be declining given the environmental reasons that we talked about. Consequently, the non-fossil fuel in the electricity generation is expected to increase, reaching around 66% by 2050. Now we get into the oil complex, which is the primary component of the world oil outlook. Although we cover all the other energy streams, we focus on oil. We see the oil demand, as we have heard in His Excellency's eloquent speech earlier. We expect the oil demand to grow by another 19 million barrels, reaching around 124 million barrels per day by 2050. It's very clear that we don't see any oil demand peak anytime soon, not in the horizon of this outlook. The demand growth is primarily driven by the non-OECD countries, which will see a growth of a staggering 27 million barrels per day, counterbalanced by the 8 million barrels per day decline that we expect in the OECD countries. Of course, the largest contributor to that non-OECD oil demand growth will be India with 8 million barrels per day, followed by other Asia of almost 5 million, and then the Middle East and Africa contributing 4.7 and 4.3 million barrels per day, respectively. Looking into the sectoral basis on where this future oil demand will come from, will be predominantly transportation with almost 6 million barrels per day contribution to that growth, followed by petrochemicals almost 4.5, and then aviation 4.2 million barrels per day. All sectors will be increasing their oil demand, except for the power generation, which, as I mentioned, for environmental purposes, will see some contraction. Throughout the world oil outlook, we have picked up Africa as a theme. It's one of the major growth centers for global energy, oil in specific. And I invite you to spend some time reading the chapter we wrote on Africa. But this is just to give you a flavor. We expect Africa oil demand to increase from almost 5 million barrels per day seen last year to almost 9 million by 2050. Of course, we dwell in a lot of details throughout the world oil outlook in Africa. On the supply side, we expect the non-DOC, non-declaration of cooperation supply, to grow by another 4 million barrels per day between now and 2030, but beyond which we will see the non-DOC supply almost plateauing at 60 million barrels per day, and then declining from that point forward. Of course, that plateauing and declining will be led by the U.S. Supply peak. The supply from the Declaration of Cooperation countries will be called upon catering and filling the gap. The DOC liquid supply will grow by another 14 million barrels per day. A very quick word on the refining. We expect the global refining capacity to increase by another 19.3 million barrels per day in the run-up to 2050, and 80% of that growth will materialize before 2040. Of course, almost the whole entire capacity addition will be from where the demand will be in non-DOC countries. We cover detailed perspectives on oil trade, that's oil and crude and condensate, as well as products. And we see the global trade of oil rising by almost 25% by 2050. That's reaching 48 million barrels per day. Of course, it will be predominantly Middle East to Asia for the obvious reasons. In terms of investment, and we have estimated last year, we continue to estimate almost the same figures. This year we updated our figures, and we still see almost $18 trillion needed for the global oil sector. That's upstream, midstream, and downstream. The upstream alone will require around $14.5 trillion investment. That's an average of $581 billion per year. As we see from the graph, as the non-DOC plateauing and then declining beyond 2030, the DOC declaration of cooperation countries will have to fill in the gap, increasing their investments in the upstream. The downstream will see a $1.9 trillion requirement, while the midstream will require $1.3 trillion. We have designated a chapter on the scenarios, of course, adjacent to around the base case that we have tabulated to the best of our assumptions. We have drafted and mapped out a technology-driven scenario in which we assume significant fuel substitution in addition to energy efficiency and deployment of a lot of carbon removal technologies, including but not limited to the CCUS and direct air capture. In that scenario, which is the lower dark green line, we see the oil demand dropping to 106 by 2050. In the equitable growth scenario, in which we assume faster economic growth, more of compartmentalization of economic growth, segregated growth around the world, we see higher economic growth at country regional level and therefore by global level, with much more or higher electricity access. Of course, lower energy poverty. We see the oil demand increasing to north of 130 million barrels per day. To wrap up and to take away from this, I'm sure we will dwell more on this during our panel discussions. We have seen the demographics as well as the economic growth growing or playing a major factor into determining the global energy need going forward. Of course, we will need 23% more energy to render support to the doubling of the global economy and to the billions of people that will move to cities requiring a lot of services. Oil will remain dominant. We don't see any oil demand in horizon, as well as a special focus was given to the electricity generation, given its role in AI as well as data center, and as many economies around the world mature into services sector. We have concluded with an oil demand growth of north of 19 million, reaching around 124 million with no oil peak demand in horizon. Oil investment will be required. His Excellencies repeatedly pounded on the need for investment and the need to continue investing in baseline fuels, oil and gas. And for that, we will need almost $18 trillion between now and 2050. And Your Excellency, if you allow us to maybe move into a short video that we have prepared, encapsulating, summarizing the world oil outlook in 4 minutes video. Thank you.
OPEC's World Oil Outlook 2026 provides a realistic view of the likely evolution of the energy landscape to 2050. In spite of a multitude of uncertainties, OPEC's perspective offers a clear path to navigate an evolving energy industry. This serves as an important platform, facilitating international cooperation and knowledge sharing to ensure global energy security. Looking ahead, the global population is set to increase by over 1.4 billion people to 9.7 billion by 2050, and the urban population by 1.7 billion, largely in developing regions. The global economy is set to double by 2050. As a result, and despite efficiency gains, overall primary energy demand is set to rise by 23%. Growth is seen in all energy sources except for coal and is concentrated in non-OECD countries. While demand for renewable energy is expected to record the strongest growth, oil retains its dominant 30% share in the global energy mix through to 2050. Demand for electricity is set to rise by around 85%, primarily due to strong growth in developing countries in Asia. This demand spike is driven by economic development, electrification across all sectors, and supported by the spread of AI and data centers. Global oil demand remains robust and is set to expand by 19 million barrels per day by 2050 to reach over 124 million barrels per day. There is no peak demand on the horizon. The primary drivers for this long-term demand growth are non-OECD countries, where demand increases by 27 million barrels per day, primarily in India, other Asia, the Middle East, Africa, and Latin America, while OECD demand declines by almost 8 million barrels per day. This growth is fueled by road transportation, aviation, and petrochemicals. Road transportation demand growth comes on the back of a large expansion in the global vehicle fleet, from 1.7 billion in 2025 to nearly 3 billion in 2050, most of which is in developing countries. The fastest growth is seen in the segment of electric vehicles, but internal combustion engine vehicles continue to dominate the global fleet, accounting for around 73% of the total in 2050. On the supply side, with U.S. liquid supply peaking in the early 2030s, total non-DOC liquids are expected to plateau around 60 million barrels per day from the mid-2030s. Consequently, the relative role of DOC liquid supply is expected to increase significantly, with an expansion to 64.5 million barrels per day. The downstream sector, the Asia-Pacific, Africa, and the Middle East lead long-term refinery capacity growth. In total, global distillation capacity additions to 2050 are projected at 19.3 million barrels per day. Secondary capacity additions over the same period are also significant. With demand continuing to grow and existing resources naturally declining, almost 18 trillion US dollars will need to be invested in oil by 2050. Two alternative scenarios to the reference case, the technology-driven scenario and the equitable growth scenario, shed light on the range of uncertainties ahead. OPEC's World Oil Outlook 2026 aims to encourage meaningful discussion by offering a neutral, evidence-based, and trustworthy perspective on our global energy future. It envisions a future in which energy is accessible, affordable, and sustainable. One that helps drive prosperity for countries and populations across the world.
And now we hand it over to His Excellency to officially launch the 2026 WOO, sir.
Thank you, Dan. So, this is to officially launch the 2026 edition of the OPEC's World Oil Outlook, the WOO 2050. Again, with gratitude and thanks to the team that worked on this in the Secretariat and all our distinguished guests who are here to talk about it. We hope you find it interesting and useful for your future. Thank you, Dan.
Thank you again, Your Excellency. And now let's also get an external market perspective on the state of play for 2026 and beyond. Dr. Amrita Sen from Energy Aspects joins us on stage now. Dr. Sen, the stage is yours.
Thank you, Dan. Thank you, firstly, Your Excellency, Dr. Khatani. Congratulations, 20 years, and congratulations on the launch of yet another fantastic long-term outlook. All I wanted to say, and I won't take up a lot of time, is just the fact that you have continued to provide clarity and continue to also anchor your forecasts in reality. I think that matters a lot in today's day and age, because we have a lot of forecasts that tend to kind of sway with where the wind is blowing. Your Excellency, you've talked about investment and continued investment in the sector. I think that has been so critical, even when we've seen certain other forecasts kind of discouraging it, and that absolutely causes a lot of volatility. I, of course, saw in the video just now about AI and data centers, and I think no conversation today can be even started without talking about Claude and without talking about ChatGPT. So when both Dr. Khatani and the SG asked me to kind of just say a few words, I just put in Woo in ChatGPT and Claude, and just to see Claude's kind of version, what is Claude's take on Woo. And it was amazing that the top 3 things it listed: one, that the Woo is known for long-term investment clarity. So that's the first tick mark, job's done. Historical accuracy. It went and talked about how OPEC forecasts have actually outperformed counterparts. We shall not name names, but I think it talked about that. And again, credit to you. Look, everybody will have different forecasts, but you have been the most transparent with the model of statistical rigor. And also, trend-wise, you have come out right that demand has come in higher rather than lower. Yes, numbers might vary, but the trend has been correct. And the third thing it talked about was the emphasis on energy realities. So I just thought you should know that even Claude, those were the 3 things it listed when you put in Woo. And I think it does say a lot about what you have built here, why we from the industry look forward to the Woo, comparing our long-term numbers with yours. Because again, providing that stability and the ground truth to compare is very important, especially when you're being very transparent about these are the models, you provide your scenarios, and sure, we can have different scenarios, but at least you know that year on year, it's not going to be swinging significantly just because, say, the political climate is changing or the investment climate is changing. That's all I had to say. Thank you. And again, Dr. Khatani, you and your team, and of course, I cannot say enough about Hytham here. We've known each other since 2010, of course. And, we are an OPEC secondary source. We work very closely. And I can tell you how much rigor goes into it. I get enough calls. The entire team at the Secretariat. If we get one number wrong, we get called. So I know how much rigor goes into this, economics, econometrics, numbers. So I don't have to ever be convinced of just the amount of work and hard work and diligence that goes in behind this. So thank you so much, and please join me in kind of, great work. Thank you. Dan, shall I hand it back to you?
Yes, thank you, Dr. Sen. And welcome to the stage. So now we're going to have a conversation about the 2026 report. And can I also just second what Amrita was saying as well? This is such a critical resource for us in the media industry, for any analyst following exactly what's happening in global energy and global petroleum markets. This is absolutely critical. So I'm really looking forward to this next conversation. And I think it's also fair to say that this year's outlook also arrives at a pretty critical moment in global energy market history as well. Of course, it's not lost on any of us on stage or in the room here, but over the last several months, the world has experienced what many analysts have described as the largest supply disruption ever recorded in the global market. Just a reminder of some of the numbers here. At the peak of this crisis, more than 14 million barrels per day of Gulf oil exports shut in. The Strait of Hormuz effectively closed. Brent crude back above $120 a barrel. Global inventories drawn down at a historic pace. LNG markets thrown into turmoil, and governments all around the world also once again confronted with that critical question that they've been speaking about for some time now, and that is how secure is global energy supply, and what does all of this mean for investment into this critical industry? So, Dr. Katani, I'll start the conversation with you because I think it speaks directly to the moment that we're in right now. We've seen some pretty serious market shocks over the years, whether that's COVID or the war in Ukraine or now this Middle East crisis. Walk us through how OPEC is looking beyond the short term to make these long-term forecasts, and maybe just give us an insight into exactly how this report comes together.
Thank you, Dan. A lot of work goes into this, and we capitalize on the other work that we do at the Secretariat. I will keep it very short because I'm eager to hear my fellow panelists on what they need to say, commenting about the WOO that we just launched. A lot of modeling work goes behind it, but a lot of statistics goes behind it. But we lean very heavily on the brain power and the caliber and the deep knowledge and insight that our experts, women and men at the Secretariat, need to bring to the game. Modeling and as well as statistics constitute a small portion of the game, but the skills and capabilities that are in the house, it's what drives most of the trends hammer out that we see in this 300+ pages document. We cover short-term in other publications in the short-term department, Petroleum Studies, and we produce another flagship publication called the Monthly Oil Market Report, and it's readily available on our website. And in that flagship publication, we address all the short-term issues that you've mentioned a few of. But we take the short-term and then we build on it to flush out the long-term trends. Again, we lean on fundamentals, supply and demand. We look into the major drivers of how the spheres of global economy and energy are most likely to unfold. We look into demographics, that's population, urbanization. We look into the various policies, which we have registered many U-turns over the past 3-4 years, again on the climate. So we look into technologies by sector, by fuel. We keep an eye on how the costs curves of the various energy streams are behaving going forward. So we anchor everything to fundamentals. We look into fundamentals. We don't get so emotional when we attend to a certain short-term event. We came out to be accurate and correct on the COVID. We have tabulated some numbers for this crisis. In the previous crisis, we had our own say in the short term, which contributed to the long term. But if we are getting both, I think, accurate compared to others, I think that tells about the capabilities that the Secretariat has, and not only on the modeling and data, but also on the skills and expertise.
And for the benefit of our live stream viewers, I do want to just focus on the short term, just very quickly, just one question on this before we really take a deep dive into the longer term outlook. Of course, we've just seen the US and Iran announcing this framework to extend the ceasefire, reopen the strait, begin nuclear talks. Oil prices have fallen back, but the details on this are still very thin. So my only question to the panel on this is this crisis over, or does it have further to run? Dr. Sen, I'll start with you.
I think we had a great discussion over lunch. No is the short answer. It's a very, very apprehensive, effectively an extension of the ceasefire, and a very, very complicated scenario as well. So, I mean, I'll let Paul and Bob and David talk more about this.
Paul, your thoughts?
Well, I'd agree. I think this is a play in probably 5 acts, and we're just coming to the end of Act 1. There's quite a lot, I think, still to play out, both in terms of how the pieces will fit together. But this doesn't feel like a watershed ending. This just feels like something which will open up another series of questions. It will remain very interesting for an analyst. I think that's the one prediction we can all make.
Bob.
Dan, you know, markets are forward-looking, but not always accurate. The macro markets priced in transitory inflation for 8 to 10 months before the data disproved it. In 2022, the oil markets priced in for 4 months the loss of 3 million barrels a day of Russian supply that never occurred. And I think now the market is pricing in the opposite, sort of an optimistic, transitory nature of this. And I think that's wrong. And as in the past, Whether it's the data coming in and showing demand's on track to peak, or I think the inventory data that will shortly be showing the world has a problem in terms of managing this supply loss. So no, I don't think it's over. As Paul said, we're in the early innings, and it's probably going to get a little worse before it gets better.
Jim.
Well, we might be at the beginning of a recovery, and certainly there'll be lots of ups and downs. There'll be more surprises. But what we're going to find out is how important inventory levels are to the market, because when we look at inventories over the last 2 months, April, May, early June, they've been falling for crude oil and products at about 5 million barrels per day. That is a huge decline, never seen it before. And even if we do start to recover production in the Gulf, it will take a long time to rebuild those inventories, and we're likely to see a demand for additional inventories over and above getting back to where we were.
David.
I would really just echo what my prior panelists have said, and the crucial importance of buffers, in terms of inventory and stocks. We came into this crisis with relatively comfortable levels of stocks, at least in some parts of the market. Those have been drawn down at record levels. But when we talk about buffers, it's also about security of supply. It's about diversity of suppliers and off-takers. It's about building in optionality to the supply system. And I think, those are some of the themes that will probably bleed into future issues of the WU and other long-term outlooks.
So that's enough looking back for now. Let's look forward. And Bob, I actually wanted to go back over to a point that you just made before, because there are many long-term demand outlooks out there. The IEA now expecting oil demand to contract this year because of higher prices and weaker economic conditions. As we've just heard, though, OPEC now projecting demand growth all the way through until 2050. What do you see as the key drivers of demand growth from this point on?
And let me just say, add to my congratulations to Dr. Khatani and His Excellency Haitham Al-Ghais. Whether you're trying to forecast 3 weeks, 3 months, or 3 decades, oil markets teach humility and require bravery. And it's against that we have to judge this now 20-year report. OPEC shows its work. It puts its numbers, its analysis out there in a way that excels and exceeds any other peer. And we are grateful for that. No one has a monopoly on forecasting the future, much less about oil. But we have to step forward. It's a long-term business. We have to step forward and do it. And look, what we know is a growing population of people who are wealthier require more of the lifeblood of modern civilization, hydrocarbons, which lifted humanity from 5 millennia of darkness, cold, and immobility. That's just real and true. Now look, have we seen sudden and massive demand destruction and demand replacements? Yes. After 5,000 years on horses, we transitioned to oil cars. It wasn't due to a peak horse policy, however. In the 1970s, the OECD burned over 40% of its fuel burn was fuel oil. And then the prices quadrupled and stuck in the 70s, and we had alternatives, coal, gas, nuclear. So we did kill fuel oil demand permanently. But one has to bring that kind of historical perspective, that honesty and transparency that you do. So I think it's richer people, more people wanting stuff, not just transportation, but the things we buy that are transported by oil. And I think that speaks to which OPEC has, and for Rapidan, and I think others here have consistently said, there's just no sign of a policy-driven peak demand by 2030 on the horizon. You've been right, and we agree.
Amrita, I can see you nodding. Did you want to add to that as well?
I think the 2 things I'd like to add is, one, the demand. Firstly, Paul's taught me this. Demand destruction is permanent. I've refused to use that phrase in the last 3 months. This is a demand reaction to price. Yes, if the price is high, you are going to lose some, people switch. And if prices go down, demand will switch back. But even before that, the first thing I wanted to say, a lot of the demand loss that we have seen in the short term is because of a lack of supply. We need to be very careful about kind of making those distinctions that if you can't get NGLs, which is so important for plastics, that doesn't mean the long-term trend of plastics demand in Asia or globally is shifting. right? So there's a temporary dislocation versus long-term trends. Now, are we seeing certain long-term trends changing? Potentially. Like, for instance, for gas in particular in Asia, there are some areas where they might be moving more towards coal because of energy security concerns. And I'm sure that is something Wu and others, all of us are now having to look at. Even coal, we keep writing the obituary, but potentially keeps coming back. That's very different from saying, OK, there's been a massive demand destruction and now coming back. And the second point is, we don't think oil prices, barring that little bit in March, have actually been high enough and for long enough to necessitate changes in behavior that sticks. So I think, again, very important to take out the short term, what we are seeing, versus and making sure that doesn't bleed into the long term, which is exactly what you've avoided doing. And I echo what Bob said. I mean, of course, demand growth slows down, but it doesn't mean outright it starts to fall in the next few years.
Also important to look at demand for what as well, right? Because the Wu projects that oil is still going to maintain a dominant share within the energy mix moving forward. Jim, can you speak to that as well and just walk us through why that's the case and how you think oil is going to perform as a component of the energy mix out to 2050?
There's a couple of really key elements in that. First of all, I have every copy going back to 2007 in my home office. I still like paper, so I hope I can take this home with me, so I'll continue my collection. So in the long term, one thing about I was very pleased to see Dr. Al-Qahtani focus on Africa in his presentation, because I think that is a underappreciated region in terms of energy demand growth and certainly oil demand growth. Africa is going to loom much larger. It already does today and will continue to loom larger over the next 20, 30 years beyond that as well. The other part, and this is why work like the World Oil Outlook is so important. It's transparent, it's an invaluable resource, it's a source of insight, but it has become more complex to look at oil and project oil demand. And part of the story is 20 years ago, 30 years ago, you could look at crude oil, refined products, and that was pretty much oil. Oil today is beyond that, particularly natural gas liquids, which is considered oil demand, but we call it natural gas liquids. And that is such a very big source of supply growth and demand growth. And that is particularly for petrochemicals. I think that's highlighted in the Wu that that's going to be one of the really important, it is today and will continue to be for a long time to come, an important source of demand growth. It's not just gasoline and diesel, that's very important, but also the other liquids, which typically haven't been in the spotlight.
So we know demand growth is rising. Oil is also going to maintain its share within the mix. David, I wanted to come over to you and also ask about where it's going to come from as well, because the Wu really highlights Brazil, Canada, and Argentina as major contributors to future non-DOC supply growth. Where do you think the future barrels are going to come from?
Well, I think certainly we're in a period of between arguably a decade in which the Americas have been dominating the non-OPEC supply growth picture. That still has a period to run. We actually look at long-dated prices now, and we even think there may be a little bit further upside even for US production if you're looking at a 2 or 3 year time horizon with prices at $75 instead of $65 a barrel. Of course, don't rely on the futures curve as a predictor of where prices are going to be, but nonetheless, the indications are that the marginal price may be rather higher than people thought. So the Latin American nations you talk about are key as well going forward. Canada has a massive resource base. And in particular, its attempts to move those barrels into the Asia-Pacific market and rely less on the US refining system as the key off-taker will be key. But we have frontier areas and, a development over the last 2 or 3 years, the sense that frontier exploration may be making a bit of a comeback, and therefore you look at areas offshore Africa and elsewhere that still hold the potential. But ultimately, as I think the report illustrates, over time it's likely that OPEC member countries with the huge resource base, will take a larger share of demand going forward.
Anyone agree or disagree with that? Jim, you want to jump in?
I just want to add to something that David said. And in the response to this crisis, there's a lot in the media about this is going to support renewables, and it probably will to some degree. But it's also going to lead to more, not less, more upstream oil and gas investment. Even before the Hormuz crisis, we were expecting global upstream oil and gas investment to increase at least 15% over the next 5 years. It'll probably increase a little bit more than that. So reactions to what's happening today and the long-term demand, we're likely to see more upstream investment than less.
Go ahead, Paul.
I was going to say, Dan, when we make a forecast, one of the only thing we know about our forecast or anyone's forecast is it can't be correct because only God knows the future, right? And we ask ourselves, where are the surprises to our forecast likely to be? On which side of the ledger? And when I think about supply and supply growth, I think the surprises in the non-DOC will come to the higher side. I think history teaches that. Innovation, AI. I think as we emerge from this cloud of believing that oil demand was going to peak soon and realize we're under investment, and that catalyzes a wave of investment. When you have smart human beings applying the best and evolving technologies, including AI, to the pressing problems of the day, and few are bigger than supplying the world with the energy it needs to maintain standard of living. When you have all that at work, you tend to figure out ways to unlock more producible reserves, maybe from 8% to 10%. You get shifts that I think put more resources in play in parts of the world we maybe never thought about. Guyana comes to mind. Argentina, who would have thought Argentina was going to be a galloping shale oil producer? So I say prepare to be surprised on the upside when it comes to investment and unlocking reserves all over the world, including the DOC countries, but also non-DOC.
David, jump in.
I absolutely agree with what Bob has just said. The tendency has been to understate what can be achieved. We mustn't be complacent, however. The report sets out in fairly graphic terms the amount of investment that is needed going forward. The lay audience out there, the general press out there, overlook something at their peril when they're thinking about the oil market. And that is that just every year we lose 3 to 5 million barrels a day of productive capacity because of mature oil field decline. So you've got to spend an awful lot of money, A, to replace that, to stand still, and then to expand to meet growing demand going forward. And it's something, if you make a plot of uninvested oil supply going forward, that falls an awful lot faster than even the most ambitious net zero projection for oil demand. So making the conditions conducive for investment, removing planning delays and pipeline permitting delays and that sort of thing is crucial if we're going to meet that demand.
Dr. Catani, just quickly, the figure off the top of my head is more than 11 trillion out to 2050 required in investment. Is that correct?
We have put it on that roll-up, almost $18 trillion investment that would be needed. The bulk of that will be in the upstream. We will need almost $600 billion invested every single year. This is to compensate for the natural depletion, the natural decline of the reservoirs, but also to add to the incremental demand growth, which we see north of 1 million barrels, fresh barrels for the new demand every year in the run-up to 2050. So the amount of investment is hefty. We have to put that pipe in the ground to make sure that we don't hit a wall, and therefore the prices spike again. And this is something that our ministers, their excellencies, have always been vocal on, that we need to start planning, because a lot of these projects, they require 5 to 10 years planning phase before you see that fresh barrel hitting the market.
Exactly. Paul and Amrita, maybe you can weigh in on this as well. We've spoken a bit about the level of investment required at the top end. What about downstream? Because there's been a whole slew of refinery closures since 2020 for a variety of reasons. What about refining capacity? Does that also require investment given the level of demand that we're seeing and what's ultimately going to be required to deliver energy needs of the future? Amrita, did you want to speak to that first?
Amrita, after you.
Yes, is the short answer. We've seen, since it started even before COVID, because back then China was flooding the market with products. We had about 3 million barrels per day of refinery capacity closed down in the West, including then, of course, accelerated over COVID. Last year alone saw another 1 and a bit million barrels per day shut down. We actually think downstream is even more challenged than upstream because the capital outlay for downstream, it's longer, right? The amount of time you need to recover. And when we went through this ESG phase and nobody was willing to invest in downstream because why are you going to be putting money into what is actually quite kind of big emissions effectively, right? It creates that. Right now, we have a situation in our long-term outlook that it shows that this year we had a couple of new refining capacity coming online in India and China, but with Hormuz, now we've had to push that back because these are all baseload Middle Eastern crude. We are effectively, just given the amount of products we've lost over the last 3 months, just to put it into context, the lack of refining or lack of excess refining capacity means all else held equal, we will take all the way till end 2028 to recover that because we don't, at least with crude, some investment has been made and there is spare capacity amongst OPEC members. Downstream just doesn't have that. So Dangote is the last big refinery. They are, of course, twinning that. There is potentially one big coming on in Kenya, but you can identify that like it's one hand, maybe two if you're lucky. That's a huge problem.
The other problem, and Paul, you can speak to this too, but the WU does a really good job of outlining how energy policy is also going to become more fragmented across regions. And I think that's important to pick apart as well. So can you speak to the refining question and also the implications of maybe global energy policy looking increasingly divergent among regions and among governments worldwide?
Yes, well, I think Amrita's answered the refining well, but on the policy side of that, and again, this is one thing where I think I would commend the report to take a step back from the headline numbers and essentially see the clarity of the analysis underneath it. I can read some of those sections, which are essentially giving the story of how does energy change in a world where the economic activity doubles and where population gets up to almost 10 billion. And I think that's the core of the report. And then all the rest of this really flows from that quality of analysis. So I would, and again, congratulate Dr. Khattani and his team, but not just for predictions and in themselves are not as useful as that clarity of thought. If people want to think differently about the future, at least here is a framework to work out on terms of the analysis. And I think that also comes from on the economic policy side, in that now things which, governments have not, consumer governments have not thought enough about energy for a very, very long time. It's been very easy to slip into a dogma approach of energy policy. We want to do this, this isn't coming from analysis. Which again, I think it's very useful to have that groundwork of getting to economic energy policy as the result of some analysis rather than the imposition of a dogma from the top. So what's happening now, I think, is energy security is back on the agenda. Concern about the nuts and bolts of the industry, the logistics. Have we got the right logistics? Do we need more built-in redundancy in the system? People used to look at built-in redundancy in energy, so an extra pipelines, extra ways out as waste, as an extra cost. And we beat down on the cost. You don't need this redundancy. Hey, guess, we do need this redundancy. There is an options value to these things. So I think all of those are percolating through. But I think the key thing from here, again, is governments not treating energy as just something which is easy to dictate and will just work. It's a frictionless thing that governments don't have to think about. And the one thing I think we have learnt from the last few months is there's a great big empty space in a lot of governments in terms of what they understand about the sheer logistics of the energy industry. So finally, just on behalf of the All Analyst Union, I said, the clarity of in the WU is great, but also I think there is a shortage of longer-term outlooks and clarity. And so I put in a word for all the other people who do long-term outlooks and other agencies, again, come to different conclusions, but at heart, they are still on that trying to change the debate and put something in. I mean, we can choose between them, but the actual exercise, get energy is important and we need to think about it. I think that's the key contribution. And this WOO, I think, is a strong advance in other years, and other years were pretty good as well.
And government should take note of this document as well, because it shouldn't take an energy crisis like the multiple crises that we've seen over the last couple of years to start thinking properly about the energy system and the required energy investment. So, Paul, you make such a good point. David, come on in here.
Yeah, I was just, your comment in your question about a sort of fragmentation of energy policy. I mean, to some extent, that's not a bad thing. I think what has been problematic over the last 20 years has been an over-prescriptive approach, particularly towards energy transition, the imposition of renewable targets and EV targets. Paul and myself were at discussions in Paris last week, and, look, really the concept that there is a different sweet spot for the penetration of EVs or the penetration of renewable energy sources in different countries. And for governments or international bodies to try and impose a rather arbitrary level of EV penetration by 2030 or 2035 doesn't make any sense. Some countries will be able to reach that, some won't. It's appropriate for some countries, it's not for others. And so I see that sort of fragmentation in some ways as more the adoption of appropriate energy policies, nation by nation. I don't think that's a bad thing.
I also, to add to that as well, I think one of the other things we've seen is, yes, energy shocks prompting that conversation, but also this trend around artificial intelligence also driving a whole new conversation about energy needs into the future, which is important for governments to be taking note of as well. Amrita, can you speak to that? How important is AI-driven demand growth going to be into the future? And what are you seeing right now that's maybe giving you cause for optimism and maybe giving you pause for thought as well?
I think the AI story is fascinating because, everyone who's been talking about energy demand, fossil fuel demand is about to peak. I think, even 2-3 years ago, it didn't feature in any of the outlooks, right? And now, and it's the biggest source of growth. And of course, natural gas will feature in that, all forms of energy. And I think that's something the Secretariat's also always talked about. The thing that worries me the most about AI is the infrastructure. The infrastructure, energy infrastructure required to serve it, right? Because that goes back to what Paul and even David is saying, because that's where you do need the governments to kind of lay out or just get out of the way in some cases to be like, if we are to support this, then, there is the grid, for instance. I personally think it's so not talked about enough, the fact that we need investment in the grid to be able to support even just general electrification needs that we are going to see, and definitely AI. The thing I find with hyperscalers in the US, I guess anywhere, because again, the lack of understanding of the energy industry, this is a long horizon industry. They want this yesterday. That's how they think about it. And they're like, what do you mean by it's going to take you 3, 4, 5 years to deliver this? And I think that mismatch of these guys who want the energy today or yesterday versus an industry that needs the guarantees, that there's regulation around it and can only fulfill that in 3 or 4 years, I think that's the clash that we are just not talking about enough, and it really worries me.
I think it was actually His Excellency who said at the start of this year that we are in the energy addition era.
Absolutely.
And the world's going to require all sources of energy and as much energy as possible. Bob, can you speak to that too?
If I wanted to tie together the refining discussion and the policy discussion, again, for the last 5 or 6 years, this peak idea narrative has taken hold and moved capital. If you think about it, the folks who believe that total global liquids would peak by 2030, we all agree non-OECD is growing. That must mean mathematically OECD is falling. And what was supposed to fall? In other words, what is the dog? Which dog is supposed to bark now for us to know? And it was a collapse in OECD gasoline demand. There's an expression, what is old is new again. It was very fashionable to build renewable diesel plants. It was very fashionable Jim's points about the NGL build out, very well taken. That's real. Boy, transportation fuels were the old horses and buggies of 120 years ago. Demand was forecasted by leading agencies some leading agencies to collapse. It had to, mathematically, for demand to peak, all driven by policies. As we emerge from that, and I agree with Amrita, our long-term outlook said, we are shortest the most unloved product in the most boring part of the world, Atlantic Basin gasoline and diesel units, the last thing on your shopping list for the last few years. And that, we think, is going to come to the fore. And we are probably entering a golden age for refining. We're certainly seeing that this year so far. And with the loss of 5 million barrels a day without redirects, a lot of that NGLs too, from the Gulf, we're being reminded. So I think really the refining story is a nice blend of these fundamentals and this policy and how it can drive capital and sometimes create or exacerbate problems. All the more reason for transparent, reasonable forecasts and data.
Does anyone else want to speak to the nexus between energy and AI, issues to be concerned about, things to be optimistic about? Amrita spoke a little bit about that. Does anyone else want to add to that?
The AI topic in energy is fascinating. One, if you take it and you look at the U.S., which is really where a large share of this is happening, the big change is electricity demand in the United States was pretty flat for a long time. Maybe it'd go up 0.5%. That was pretty exciting. So if you go from 1% growth to 1.5%, that's a big change over a number of years. I think some of the more fantastic outlooks for gas demand because of AI are being tampened down a little bit. But what we'll see more AI, we'll see more energy, and we're going to see greater efficiency because one, cooling these facilities is a very large share of the cost. And when that happens, you have efforts to make it more efficient. So we'll be using more natural gas, we'll be using more AI, but it will become more efficient over time. There's also some societal pressures in some places. Some places don't want more of these data warehouses in parts of the US, probably elsewhere. So it's going to be up and down. It's not going to be a smooth road up. But don't discount the power of innovation and efficiency to actually lead to more energy demand, but not of some of the more fantastic rates that have been put out in the last couple of years for AI-powered gas demand.
Paul, can I ask you about this as well? With regards to the energy transition, obviously a really important topic a couple of years ago. I feel as if it's less in the oil and gas narrative right now, definitely less in the media narrative under the Trump administration. How do you see the conversation around AI and the energy requirements moving forward, shifting the conversation around the energy transition as well?
Yeah, I'm just on energy transition. I think as Dr. Al-Qahtani put very clearly, this is about increasing. It's only coal where demand is falling away. There isn't a transition from the other in that sense. And again, I think that sort of naive policy view that we are going to go to 100% renewables and to take away, that's really where the pushback has been in. And when people say transition, it tends to mean different things to different people. And at one level, we find the transition is one that believes we can do all this with a small a few segments of Dr. Al-Qahtani's energy pie, when in fact it's a story about not transitioning, it's about providing more energy, full stop. I mean, obviously within that, the biggest role being played here isn't on transition, it's about energy efficiencies. And so from the WU numbers, it's a doubling of the economy, but energy use goes up 23%. So efficiency is doing a lot of work already. And so in that sense, we shouldn't be over-egging it and thinking that it can do more than bringing down the energy intensity as much as is already in these figures. But on AI, I think that link between AI and the upstream is the interesting one. And the key thing here is about the cost curve. Because we do, at a high enough price, you can do fabulous things with technology and different there. The question is what can be got to work where the back end of the curve is now. And this is where I feel things have changed a bit, because up to now, particularly computing power, has always been a process which has, over time, has managed to minimize or at least drag back the rate of cost increases. You have to do a bit more. We're now at the point where this stuff is now suddenly becoming really expensive. Your iPhones are going to cost more because the chips are costing more. anymore. AI is phenomenally expensive. Look at all the trillion valuations in the AI companies. But where's those trillions going to come from? It's going to come from you and me and the general public. So in other words, the idea that AI is not a free thing which can be used to solve all our other issues. It's going to be quite an expensive thing, and we can do some really whizzy stuff, but don't expect to do really whizzy stuff upstream at ever lower prices. And so it's back onto that back end. And I look at some of these energy costs in AI and the general cost of AI and the way the capital markets are viewing AI, and the back of the curve makes no sense at $70. You start thinking, let's start at 80 and then start thinking about a little bit higher. So I think that's the interesting thing, is if it transforms the industry, will it be transforming the industry to a higher cost curve or a lower cost curve? And I think at the moment, given that we're moving out of the easy acreage or moving into tertiary acreage in the US, and we will do in other areas, all we're doing is managing to sort of, row against the stream a bit and hold position. We're not gaining overall. So maybe this is the time when there is a transition going on, and it's one to sort of just seeing how these bits fit together in a slightly different way.
Dr. Khattani, would you agree with that?
I would agree with everything that my fellow panelists have talked about, especially about the AI. We've picked up on that trend almost 3-4 years ago, and we decided to look into the electricity market deeper, into the generation and the demand side, not only for the attending to the AI requirements, which we see at least multiplied by a factor of 5, but also on the electrification of transport fleets. The AI may not be competing one-to-one with the oil use, but it's more on the electricity, and we related it a whole lot to the development, because everybody has the right to the development, especially if they possess these natural resources. We haven't really talked much about the southern hemisphere. That's where the future is. This is where the population, economic growth, the perceived emission, this is where the policy enact will make a difference. The OECD region, as we tabulated throughout the book, is pretty much peaked or peaking and getting less relevant to the debate going forward. So I think to watch for the issues of energy poverty, emission, energy access, which we tried to address, although at probably a high level. Fortunately, we still see these issues living with us over the next 25 years. And this takes us back to what His Excellency has mentioned in his speech, and keeps repeating. His Royal Highness Prince Abdulaziz tells us when it comes to what's happening next. I think we all need to be humble, and the principle of the humility dictates that we can't tell what's going to happen tomorrow with great degree of certainty, but we are aware of the critical uncertainties that could constitute a difference in the picture. And the picture as we see it is that it's South-South story going forward. Development will be on the top agenda of every nation, because it's their right. Now the challenge becomes how to deploy all of the above fuels, maybe with the exception of coal, given the environmental dimension of it, to ensure and secure the prosperity and the development that the South-South will demand going forward. So AI, the transportation, the electrification, all interlinked, but at the end of the day, it's the major drivers when it comes to demographics, comes to the economic growth that we need to cater to if we want to secure the 2.9 average throughout the horizon of the outlook. For us to see the prosperity and the development of the South-South, we will have to use all the fuels, all the technology, and make sure that we have all the people on board.
And having an intimate knowledge of the outlook to 2050, you've obviously studied a whole range of scenarios. What would you say is the #1 critical challenge facing global energy markets out to 2050? If you could identify one thing, what would it be?
Ill-advised policies. I wouldn't name politicians who would experiment and tinker toy with the prosperity and development rights of nations. But when they enact a policy and then 4 years down the road, they need to draw it and offer an alternative policy, pull out of certain agreements, propose, maybe push the consumer certain unsustainable way. I think experimenting with people's livelihood is the thing to watch out for. And we try to tabulate. We keep a tally on daily basis, weekly basis, on who's taking those severe U-turns. And unfortunately, we have been registering a whole lot of them over the last 2-3 years.
A few other points I also wanted to ask our panel about as we continue to push through some of the key themes here. David mentioned this earlier, but Jim, I wanted to come to you on this, and it's something that Dr. Katani also just mentioned around EV adoption and what we're seeing in the EV space as well. The growth has been concentrated in several regions here, especially in China, also in some parts of Europe. How do you see the future of EV uptake in the long term, and what are some of the major determinants to this growth? I think it's an important conversation. We've spoken a bit about AI, we spoke about where demand's coming from, but the EV conversation also pretty critical.
I really like that question because I'm in the oil analyst union with Paul and the others. I'm also in the EV analyst union too, if there is such a thing. I think the EV story is fascinating. It's largely about China. And we can debate the costs and the policies China pursued to get where they are. But the fact is today, half of car sales in China are cars with a plug, mainly BEVs, a lot of PHEVs, but cars with the plug. China is now the largest automotive exporter in the world. EVs are part of that, not all of it, but a part of it. They surpassed Japan a couple of years ago. And a lot of these cars, if you don't include tariffs or other issues, they're quite competitive. They're not for everybody, not for every region of the world. The automotive industry is often involved in politics. Look at the U.S.-Japan relationship in the 80s and the trade frictions. The U.S. and Japan were allies at the time. Look at those frictions. So the China EV story is really a key uncertainty, unknown about the future. And the key is, particularly in the South, we're talking about the South Africa, parts of Asia, because that's where the future of energy is going to be determined. To what degree will EVs penetrate in those markets? Will they be allowed to penetrate? In countries where there's a notable automotive manufacturing presence, they may not be as embraced as in other countries. So it's not as if they're likely to go everywhere. They won't. In some places, they will work. But even today, if you look, even with the fantastic sales growth rate of EVs in China, as I said, 50% new sales, the global fleet of all the cars in the world is just about 6% EV or so. It takes a long time for that fleet to change. And every year, this year, next year, however many years ahead, there are going to continue to be more gasoline-powered cars on the road as well. So this, I think the EV story, it's fascinating, it's really important, but it is part of the broader story about energy addition, or as we like to say, energy expansion.
Bob, can you speak to that as well? Because I wanted to bring a US perspective into this too. With regards to US energy policy right now, how would you characterize some of the recent shifts that we've seen, and what do you think it means long term, especially with regards to shale, for permitting, renewables, emissions? I think we've seen a pretty big shift in the United States over the last decade. What does the future look like to your mind?
So we went from all of the above under President Bush and President Obama. And under that, we had our best success ever in terms of bipartisan energy policy. We removed the critical threat to shale, the export ban. The last, and hopefully not the last, but the last one in history. Then President Biden came in, and President Trump came in, of course. President Trump came in, and we shifted more towards a fossil fuel friendly kind of a approach, but it was mildly implemented, I think. President Biden comes in and flipped back to keep it in the ground. I mean, the signature campaign policy of the Biden administration was banning the use of coal and gas and electricity generation, I think in 2035, that's 60%. That was the number one, a departure from the Obama administration. Then President Trump came back and swung us heavily the other direction. If there's one thing President Trump detests on this earth, it's a windmill, right? And so we're polarized, we're swinging back and forth. We have to ask ourselves, who's going to come back in power? I think even if the left comes back, though, they've experienced what we all have since the Russian invasion of Ukraine, what we're seeing right now. The Democrats are not going to go back to the Paris Agreement, I don't think. But they've also seen a president use executive powers strongly. And so could a new president come in and say, climate emergency, no exports of LNG until we see more renewable build out, or no more oil exports until inventories are up, or the oil companies give us more money. So I think this polarization in the United States, while climate change per se, I don't see will come back as a it never really was that big in the United States. The Democrats will come back. They will be hostile to the industry when it comes to permitting and so forth. It'll be difficult. I think, as perhaps in other countries, the United States only moves forward after we hit the wall. We have to hit the wall, touch the hot stove, have blackouts, have high electricity costs, and then we will do the right thing in terms of sensible policies. But as you know, my old expression is, I think it's going to get worse before it gets better.
And I also wanted to give Dr. Khattani to make some concluding remarks for us. But before we do that, is there anything on the WOO for this year that we haven't spoken about? Is there a critical issue on your mind that you think we need to raise on this stage, or maybe something in the report you've seen that we haven't discussed? Raise your hand, speak now, or forever hold your peace. Anyone else wanted to add something before we pass it over to Dr. Khattani?
I would just say a hot topic, certainly in Washington, I think in other capitals, is critical minerals. Now, that's not strictly an energy consumption or any supply issue, but it's certainly critical to the workings of the global economy and the energy industry. And I think what we're seeing there, a reaction to the dominance of the geographic concentration of that industry, that is a key storyline that's unfolding today and the years ahead. And it's going to have a big impact on the economy and energy.
David?
Yeah, I would just say again, congratulations to the Secretariat. The framing of the different scenarios, I think, is incredibly useful. Now, it's been in the report for a couple of years now. Full disclosure, Argus Consulting's view is probably more aligned to the technology-driven scenario, but the value of having the reference scenario, the technology-driven scenario, and the equitable growth scenario, I think, is immeasurable. We all know that forecasting is a hazardous business at the best of times, and that envelope of uncertainty that you've created with a reference scenario in the middle, I think, is incredibly valuable.
Anything else to add here? Dr. Khattani, I think I'll hand it over to you then. Just to wrap up, what conclusions would you draw from our conversation today? And if there's a key finding from the WOO that you think our viewers or anyone in the room should walk away with, what is it?
We all look forward to His Excellency's concluding remarks, but just to take away from this panel and capitalizing on what we have included probably in the book, we will need to consume a whole lot of energy going forward in order for us to double our global economy size, and this is to attend to the 2 billion people moving into cities and what have you. The challenges are huge, but very doable. The future is almost south, non-OECD countries, so and therefore policies and investment on the developing part of the world will be very helpful to keep an eye on, to attend to the energy poverty, energy access dimension. We will need definitely a whole lot of energy because energy is prosperity and development, and it's the right of everyone. Oil will not be peaking any soon. Oil will still command the top rank when it comes to the global energy mix. We will need a lot of investment, especially in oil, and we need to be aware of the uncertainties, and we tried our best mapping out 2 alternative scenarios. So uncertainty is huge going forward, but it's good to keep an eye on the fundamentals. And fundamentals is what would guide your foresight and your predictions going forward.
Well, thank you, Dr. Khattani. And I also want to thank my panel. What an outstanding lineup. Congratulations to OPEC for pulling together such an esteemed group of professionals. And thank you again for being here today to walk us through it. And with that, Your Excellency, I'll pass it back over to you to make some concluding remarks.
Thanks, Dan. First of all, let me start by thanking our distinguished panelists who joined us today and shared their insights. Thank you for your words of appreciation for the team that put, I'd say, a good 9 to 10 months of good, hard, solid work into coming up with this. I'd like to take this opportunity really to thank everybody else who's involved in this, the organizers of this event and the Secretariat, and of course, none other but our moderator and the Master of Ceremonies today, our friend Dan Murphy from CNBC. Panelists, Dr. Khattani, the Director of Research Division, Paul Horsnell, Bob McNally, Dr. Amrita Sen, Jim Burkhardt, and David Fife. Of course, also, as I said, a lot of work has been put into arranging this event, months of hard work, so I'd like to again really give everybody who's been involved a round of applause and thank everybody who's joined us online. It's been a pleasure really to be part of such a stellar lineup with everybody. As again, to recap some of the key messages, I'd like to say that this year's edition of the WU should be viewed as a milestone publication. I said this in my opening remarks, it's been repeated here. This is the 20th anniversary, first issued in 2007. Over the past 2 decades, it's been an essential reference tool for all stakeholders, a publication that continues to go from strength to strength. You heard from our distinguished panelists. The WU has become a data-driven, pragmatic, and a holistic outlook that takes on board all the realities before us. And I underline the word realities. Realities in terms of issues related to energy security, availability, and of course, reducing emissions. It's a central element in OPEC's outreach, and it's a vital component for dialogue and cooperation. At the heart of the WU 2026 is a simple concept, the concept of embracing all. The world will need to utilize all energies in the decades ahead, and oil will retain a leading role in the energy mix. And let me repeat it one more time. There is no peak in oil demand. The world will need to develop all available technological solutions to focus on reducing emissions. And the world needs to ensure it takes on board the energy needs of all peoples around the world. For this, policymakers need to ensure that there is a long-term investment-friendly climate in place, one that works for both producers and consumers, and developed and developing nations. Through OPEC and our partners in the Declaration of Cooperation, this is supported through our decisions and actions that are taken to help bring stability and balance to the oil markets, and through the associated Charter of Cooperation that is vital to help evolve long-term energy futures, ones that are built to work for us all in a just and equitable manner. So thank you all again for being part of this launch of our milestone 2026 World Oil Outlook. Thank you all. Thank you.